their markup on their items is so large that they can handle that loss on the percentage because they know the psychology on a macro scale is going to have people that are going to overspend. Welcome back. Today we're going to talk about the top 7 tips that you need to know before you get your first credit card. And as a little disclaimer, it might seem like I'm a little pessimistic towards credit cards, and I'm not. They're awesome tools for making a lot of money over a long period of time. But it's important that you understand the psychology and the marketing tricks behind why banks do what they do so that you set up the right habits initially moving forward for the rest of your career with credit cards. Now, number 1 is to always have a budget. And I understand that Dave Ramsey fans out there are going to mention how he always states that anytime you have a credit card, you always spend more based on psychological studies. And there are levels to truth to that on a macro scale. But that's where having a budget comes into play because it doesn't apply to all cases if you have the right parameters in place. And most people fail in this one because they don't set a budget before they start spending. I like to think of credit cards like playing with fire. Now, they can be used to forge and create a lot of money and opportunities for yourself. But if you make mistakes, you're going to get burned, which is why when we're starting off, we don't just start with a flamethrower. See, that's where the budget comes into play. You keep the safety precautions for yourself, but more importantly, you actually can get a really good data set of where you're spending money effectively. Now, for me, I use mint.com. It's a great source. I know there's a lot of different apps out there, but on there you can actually track everything that you do, categorized. If you're spending this much in fast food versus groceries versus insurance, it can actually learn what your spending is and start allocating those things automatically for you. It is a fantastic resource. I've used it for over a decade. I would suggest it for anyone. But overall, the most important thing is that however you choose to do things, be it Excel or another budgeting app, that you have a budget in play so that you understand where you spend your money, where you can save money. And when it comes to credit cards, understand which cards are going to work best for you based on where you already spend money so that you're not chasing bonuses and chasing categories that are unnecessary based on your current lifestyle. So when you're first getting started, I would actually suggest using a debit card instead of a credit card. Now, there's a lot of reasons why you need to switch to credit, but it wouldn't hurt for at least about a 6-month period to just use a debit card while you're learning how to budget effectively. That way you're not spending in areas that you shouldn't spend. You should still spend the same way you were before, but track things on your budget. After that period is over, then you can have a good data set to see where you spend effectively, know what credit cards are right for you, and then you're ready to transition into that next step. Now that we have this base, let's lead this into number 2, which is that we are always paying off the balance every single month, no matter what. They'll have companies that are going to advertise different interest rates. It could be 20%, 10%, 15%, a special 7%. Nobody cares. It never matters. That only applies if you are not paying off the balance every single month. And if you're not paying off the balance every single month, you don't need a credit card. That's what's important about using that first 6 months with a debit, is to set up the right habits to make sure that you don't overspend and you're budgeting effectively, because there's no scenario ever where you need to not be paying off that statement balance every single month. Now, there's a couple tricks that they're also going to put in play that might try to make you think that you're paying effectively when really you're just playing their game. You're not playing them. An example of that would be pay as you go. Now, a lot of people are becoming more educated on what interest is and the effect it can have on your personal finances. So what they're doing are these 0% interest pay as you go plans, where you'll see something like a charge, every single charge you can modify, where you get 0% interest, but at the same time, there's actually a monthly fee tacked on. That monthly fee is in the fine print you don't always see. So just understand that 0% interest could sometimes be okay, but in reality, it's probably a trick and you're probably still paying the same fees that are interest, just called something else. And with these balances, if you don't pay off the full balance every month, most companies will only require about a 2% minimum payment. To give you an idea of the math of how bad that is, if you just pay the minimum payment where you don't get late fees, but you're still paying interest. Let's say you have a $1,000 bill with a 20% interest rate. If you pay that 2% minimum balance, over the time that you pay it, that real $1,000 bill will be $3,126. And it's not just that one time how horrible that math is. It's that you're setting up a psychological habit in your brain that that's okay. And it's just going to destroy you long term. Now, number 3 is that we don't pay taxes ever. And I think that's kind of obvious that if legally you can avoid paying taxes, you always do it. And in the credit card rewards game, there's always a way we can avoid paying taxes in a legal way. Now with that, you never, ever, ever take cash back on your rewards. Now with it, you can take a statement credit, which is a much better option than cash back, and they're essentially the exact same thing. The only difference is one you pay taxes, one you don't. Now let me go and give you a scenario. Let's say once again you have a $1,000 bill. With that, we had a 5% credit card, so we got $50 in rewards. What we're gonna do is we're gonna take a statement credit. So we're gonna take that 50, deduct it off of that 1,000, almost like a coupon, and we pay that credit card company back $950. However, if you were to do a cash back, what would happen? That same $1,000 that you spent, $50 back in rewards, you'd pay the credit card company $1,000, they would pay you back $50. It's still the same $950. The difference though is that they actually paid you $50, and according to the IRS, that is taxable income, the same as your job. So you never want to do that because they're both the same scenario. One you pay taxes, one you don't. We always take statement credits, never cash back into your actual bank account. Now, we'll call it 3.5. Another option is that there's a lot of travel rewards and gift card bonuses. Those are also going to be tax-free, and they're great options. And with a lot of cards, you're actually going to get a higher redemption value through travel, through airfare, hotels, everything like that, than you will through statement credits. However, if you're just getting started in this game, I would suggest just sticking to the statement credits for now, getting your feet wet, understanding how this works, and then as you get more experience, you can go into that whole other aspect, because if this is a bachelor's, travel rewards is going to be the PhD. Now, number 4 isn't going to apply to everyone, but if you can pull it off, it's really, really helpful, and that's becoming an authorized user on your parents' credit card. My parents did this for me. I'm going to be doing it for my kids as well. It really helps with your credit score and saves you a lot of money long-term when you're first getting going. Now, the top 3 factors that go into improving your credit score are successful payment history, credit limit, and time. And those top 2, we can actually get a pretty good score pretty quickly. However, time is the most difficult one because obviously it takes time. That's where being added as an authorized user makes such a big difference. Now, an example that my parents did, they added me to a Discover card that shows my report from 1993. So when I got started in my 20s, I had decades of experience on that time factor, which overall helped boost my score to over 800 very quickly. It's one of the most important things that a parent can do if you can pull it off. You have successful payment history and all the other factors that I've mentioned, but if you can do it, it's a huge deal. It puts you way ahead of the game on auto loans. Home loans can save you thousands over an extended period of time. Now, number 5 is watching out for the term select merchants. Now, this will apply to a lot of new credit/debit reward cards you're seeing ads for on Facebook, store credit cards, and then sometimes things through American Express's offers or Chase offer portals. You can see things on there like 10 to 15% cash back on a purchase. And that sounds great on paper, but what you have to watch out for is making sure that you understand the psychology behind why they're doing this. It's because you're going to be seeing the same list of stores, things like Gap, Banana Republic, that in reality, their markup on their items is so large that they can handle that loss on the percentage because they know the psychology on a macro scale is going to have people that are going to overspend, and their margins are still going to be that high even with that kind of discount. It's designed to make you spend more, which is why we go back to step number 1. We have an effective budget where when we use credit cards, we're only buying things that we already plan on buying. If you make enough money, that's part of your lifestyle. Okay, it's not the end of the world, but you don't want to just chase a 15% discount on something you weren't going to buy, especially if it's marked up, because in reality, that's an 85% loss. Now, number 6 is my personal favorite. It doesn't apply for everyone. You have to be married, but it's irritating how much no one seems to do this. And it's 2-player mode. It's so easy and it's so incredible. Most people, what they'll do is when they go to get a credit card, spouse 1 will get a card. They'll have an option to add an authorized user. They'll add their spouse to it. They might get 1 sign-up bonus and then they move on. 2-player mode splits that up. Both players work as a team, but individuals on paper. So what you'll do is spouse 1 will get their credit card. For this example, we'll talk about the US Bank Altitude Connect card. It's offering $500 back on $2,000 to spend in the first 120 days. So spouse 1 gets that card. They spend that $2,000 they were already going to spend over that time period. They get their $500 back. Then player 2 applies for the same card individually and gets the exact same bonus over that time frame. Now instead of $500, you actually got $1,000 out of that new credit card. Now with that, having 2 players, it also means you can double up on the amount of credit pools. As most people understand, you can't get unlimited credit cards. We can't apply for 20 credit cards necessarily in one day. We have to space it out. But with 2 players working individually on separate accounts, you can double up on your time frame. So in a way, it's actually cut in half while your bonuses are doubled. It's a fantastic option. Anyone married, assuming they have a spouse that they can trust with the finances, can do this. Now, some people might have the opinion of, well, we have joint finances. We don't split our finances. That's fine. I do joint finances with my wife as well. And that's where a budgeting app like Mint comes into play. Because on there, you can sync your credit cards, your investment accounts, your regular checking and savings accounts, all in one portal. So even though you have 2 separate accounts, it's linked together. Both spouses can actually see where things are being spent. You're taking advantage of the system by getting double bonuses, but at the same time, all your finances are still joint and together. So this leads us into our final tip, tip 7, which to be honest is gonna sound like a contradiction based on what I just said, but hear me out. And that's watching out for large sign-up bonuses. In today's environment, sign-up bonuses can be eclipsing $1,000, which is fantastic. However, you have to understand that the larger the marketed sign-up bonus, typically the larger the annual fee. And when you're just getting started in credit cards, you want to have a card that you want to hold long-term, which typically isn't going to be one of these because the fees are going to eat at you year after year after year. It's based on your spending a little bit, which is where that data set comes into play. But hear me out. Let me give you an example of this. Right now, the American Express Platinum card, it's one of the most elite tier 1 cards, is offering 100,000 points, which American Express varies a little bit, but it's roughly about $1,000 based on how you redeem it, with a $695 fee. So if you called it 1,000, you have $305 in profit that first year. Now that card has a ton of perks. It's got things like gym credits, airline credits, lounges, Walmart Plus subscriptions. These are great items. But if you don't use this consistently, it's not worth paying an annual fee for a product that you were never going to spend money on to begin with. I don't want to pay $155 as a credit for a Walmart Plus subscription that I don't even care about. It's important to make sure that this actually hits your right spend for yourself. And that's once again, step 1, the budget comes into play. Because if we didn't use these credits, year 2, that $695 fee hits again, we're in the negative. So you have to make sure just to watch out. Sign-up bonuses can be fantastic if the card is effective for you, but you have to be able to use your data set that you can fall back on, those parameters, to make sure that sign-up bonus is worth it for you long-term. When you get later into the game and you have your good base of starter cards that are building your credit score, then you can start getting into that churning environment, but you don't want to get into that until you've got your good established base before you move forward. So that's our list. If you like this video, we're gonna be putting out more content on investment accounts, retirement accounts, credit card hacking, bank hacking, not paying taxes illegally. So please, if you did like it, like and hit that little subscribe button because it makes a big difference with the YouTube algorithm and you seeing more of our future content. Thanks for watching.